We have talked about the 10-step accounting processing cycle. Now let's look at an example here. So this handout is posted on your island, and please spend, this example may take half an hour to finish. So please just pause your video and take about half an hour. Try to work on this example on yourself first. So we have all of the transactions here. And then the first, I'm asking you to prepare the journal entry for each of the transactions listed above. So the first one, owner invests 50,000 cash in the corporation in exchange for 5,000 shares of common stock. What is the journal entry? The journal entry is to debit cash 50,000, credit common stock 50,000. Because in this situation, cash increased by 50,000 and then common stock increased by 50,000. Number B, equipment is purchased for 20,000 cash. So equipment is purchased for 20,000 cash, which means the firm spent cash. Cash decreased by 20,000. At the same time, the company is getting equipment. So equipment increased by 20,000. So we debit equipment 20,000, credit cash 20,000. The next one, on the first day of August, 6,000 rent on building is paid for the months of August and September. So this is a prepayment, right? So cash is paid in advance of the economic event. What is your journal entry? Cash is paid, so cash decrease. And at the same time, expense hasn't occurred yet. So this is a prepaid rent, or which is an asset for the firm. So debit prepaid rent for 6,000, credit cash for 6,000. And then the next one, merchandise inventory costing 38,000 is purchased on account. The company used the perpetual inventory system. So the company purchased inventory, so inventory increased, and it is purchased on account, which means the company hasn't paid in cash yet. So this is an account payable for the firm. So debit inventory 38,000 and credit account payable for 38,000. Next one, 30,000 is borrowed from a local bank and a note payable is signed. So the company borrowed money 30,000, so cash increased by 30,000. At the same time, a note payable is signed. So this is a liability for the firm, which is a note payable. So number E, debit cash 30,000, credit notes payable 30,000. Number F, credit sales for the month are 40,000. The cost of merchandise sold is 22,000. So this is the company made a sales for 40,000, but this 40,000 is not received in cash. It is a credit sales, which is an account receivable for the firm. The cost of merchandise is 22,000, which means that inventory decreased by 22,000. At the same time, the cost increased by 22,000. So debit accounts receivable for 40,000. Credit sales revenue for 40,000. At the same time, debit cost of goods sold for 22,000. Credit inventory for 22,000. Number G, 15,000 is collected on account from customer. So this one, 15,000 is collected. So cash increased by 15,000 and collected on account from customer, which means that it was for a previous sale. When the firm made a previous sale, it is recorded on account. And now the customer is paying the firm. So account receivable goes down by 15,000. So debit cash 15,000 and credit accounts receivable for 15,000. The next one, 20,000 is paid on account to supplier of merchandise. So this one, 20,000 is paid, so cash goes down by 20,000. And then it is paid on account to suppliers of merchandise, which means that it was a previous account payable. So previously, the company bought supply from this merchandise. However, the company didn't pay it. So the company bought it on account. Now the company is paying it back. So the account payable will go down. So number H, debit accounts payable for 20,000, credit cash for 20,000. The next one, salaries of 7,000 are paid to employees for August. So salary of 7,000 are paid, so cash goes down by 7,000. And this is a salary for the month of August. So we record it as salary expense. Debit salary expense for 7,000. Credit cash for 7,000. The next one, a bill for 2,000 is received from the local utility firm for the month of August. So this one, a bill is received 2,000 for the month of August. So that means the utility expense for the month of August is 2,000. However, the firm hasn't paid it yet. So that is account payable for the firm. Debit utility expense for 2,000 and credit accounts payable for 2,000. Next one, 20,000 cash is loaned to another firm, evidenced by notes receivable. So which means the cash goes down by 20,000. And then it is a notes receivable for the firm. Debit notes receivable for 20,000 and credit cash for 20,000. The corporation pays its shareholder a cash dividend of 1,000. So here, cash goes down by 1,000. At the same time, so there are two ways to do journal entry here. On some of the book, it will tell you to debit dividend account for 1,000. And then you are going to close out the dividend account to retain earning. But here we're just going to debit retain earning directly, which is also okay. So debit retain earning 1,000. Credit cash 1,000. So this is the third step in a 10-step accounting processing cycle, which is to record the journal entry. So all of those are journal entries that we just did.